Imagine two people with the exact same starting point in life. Same age, same salary, same opportunities, same city, same education. The first person is Ethan. Every morning, before his feet even touch the floor, Ethan opens finance Twitter. He scrolls through market predictions, recession warnings, crypto hype, and screenshots of strangers supposedly turning $5,000 into $1 million overnight. He has a Robinhood account, a Coinbase account, Discord alerts buzzing on his phone, YouTube investing gurus in his subscriptions, and newsletters flooding his inbox every single day. He buys stocks after seeing green candles online. He panic sells when markets crash. He jumps into meme stocks because everyone else seems to be getting rich. Every weekend, Ethan spends hours rebalancing what he proudly calls his portfolio. Over the next 25 years, he watches CNBC during lunch breaks, listens to finance podcasts during commutes, checks stock prices while standing in grocery store lines, and makes thousands of trades trying to beat the market. He feels productive. He feels informed. He feels like he is working hard at investing. The second person is Sophia. One quiet Sunday afternoon, while drinking coffee in her kitchen, Sophia opens a brokerage account at Fidelity. She deposits $10,000 into a low-cost S&P 500 index fund, sets up an automatic transfer of $100 every month, and then mostly forgets the account exists. She does not watch financial news. She does not wake up checking charts. She does not care about the latest stock trend. When CNBC anchors are screaming about a recession, Sophia is sitting at her daughter's soccer game under the evening sun. When Bitcoin doubles and everyone at Thanksgiving dinner starts talking about crypto, Sophia quietly smiles and keeps reading her novel by the window. The investing app sits buried inside a random folder on the third screen of her phone. She opens it maybe twice a year. 40 years later, Ethan and Sophia finally compare account balances over dinner. Sophia quietly built massive wealth, potentially over $1 million through steady investing and time. Ethan, despite all the effort, stress, and obsession, has dramatically less. That outcome is not luck. It is not talent. It is not market timing. It is math. And the math has predicted this exact outcome for decades. The hidden truth about investing is that effort and returns are often inversely related. The more people trade, react emotionally, chase trends, and constantly optimize their portfolio, the worse their long-term results usually become. Meanwhile, the lazy investor quietly wins through patience and compounding. The S&P 500, which tracks the largest publicly traded companies in the United States, has historically averaged around 10% annual returns over long. Some years are terrible, some years are incredible, but over time, the average stays remarkably consistent. Adjusted for inflation, the real return is lower, but the principle remains exactly the same. Money compounds fastest when it is left alone. If you invested $10,000 and never added another dollar, after 10 years, around $26,000. After 20 years, about $67,000. After 30 years, roughly $175,000. After 40 years, nearly $450,000. And remember, that is with zero additional contributions. Now imagine adding just $100 every month automatically into the same account. Over decades, that tiny monthly investment can snowball into hundreds of thousands more. Increase it to $200 or $500 a month, and suddenly you are talking about life-changing wealth. This is what people mean when they call compounding the eighth wonder of the world. Compounding feels weak at first and unstoppable later. The first 10 years feel slow, almost disappointing. You look at the account and wonder if investing even works. The growth feels tiny compared to the effort of earning the money in the first place. But eventually something changes. The returns start earning returns on previous returns. The snowball gets bigger every single year. The first doubling might add $10,000. The fifth doubling might add hundreds of thousands. The curve eventually goes from a gentle slope to something that looks almost vertical. And the craziest part is that you did not become smarter during those years. You did not suddenly discover secret investing knowledge. You simply stayed in your seat while time did the heavy lifting. So if the math is this simple, why do most people never experience it? Because humans are emotional investors. People panic during downturns. They stop investing during recessions. They chase hype after prices already exploded. They sell low and buy high without even realizing it. The average investor constantly interrupts compounding before compounding has time to work. That is exactly why index funds outperform most active investors over long periods. An index fund is basically a giant basket. Instead of trying to guess which company will dominate the future, you buy tiny pieces of hundreds or thousands of companies all at once. Funds like the Vanguard Total Stock Market ETF or a basic S&P 500 index fund automatically own huge portions of the market. If one company fails, the damage is tiny. If great companies grow massively over decades, the fund naturally benefits. You are no longer trying to pick winners. You are simply owning the market itself. And here's the uncomfortable truth. Most professional investors fail to beat this simple strategy consistently. Professional fund managers have teams of analysts, expensive offices, Bloomberg terminals, and Ivy League resumes. Yet over long periods, most still fail to outperform low-cost index funds. Warren Buffett understood this years ago. He famously recommended that ordinary people should simply buy a low-cost S&P 500 index fund and leave it alone forever. Not hedge funds, not complicated trading systems, not nonstop predictions, just one boring index fund. Why? Because simplicity wins more often than complexity in investing. Another huge reason index funds dominate is fees. Active funds often charge high management fees every single year, whether they perform well or not. That sounds small until you understand what decades of compounding do. A 1% annual fee difference can quietly destroy hundreds of thousands of dollars over a lifetime. That is money disappearing not because the market failed, but because costs slowly drain the account year after year. Low-cost index funds avoid most of that problem. Some modern index funds charge fees so tiny they are practically invisible. But even fees are not the biggest problem. Human behavior is. An index fund does not panic during crashes. It does not care about scary headlines. It does not react emotionally to elections, wars, or market fear. It simply continues owning the market while compounding quietly keeps working in the background. That is why the lazy strategy works so well, and probably will continue working long after all of us are gone. The strategy itself is almost boringly simple. Capture your employer's 401k match. Max out a Roth IRA is eligible. Use an HSA if available. Invest consistently into low-cost index funds. Automate everything, then leave it alone. That final step is where most people fail. The hardest part of investing is not intelligence. It is patience. The market will crash many times during your lifetime. There will always be terrifying headlines. There will always be people getting rich faster than you through some trendy asset. But history keeps repeating the same lesson over and over again. The investors who interfere the least often end up with the best long-term results. Some studies even found that the best performing brokerage accounts belonged to people who forgot they even had accounts. Doing nothing literally beat doing something, and this is where most people get distracted. The lazy investing strategy itself is simple. The hard part is protecting the money that was supposed to go into the system in the first place, because wealth is usually destroyed long before investing even begins. The oversized car payment, the lifestyle inflation after every raise, the giant mortgage that consumes half your paycheck, the constant upgrades that feel normal because everyone around you is doing the same thing. Most people do not fail because they never learned what an index fund is. They fail because their income gets absorbed by lifestyle traps before compounding ever gets a chance to start. They fail because their income gets absorbed by lifestyle traps before compounding ever gets a chance to start. That is why personal finance is not really about finding magical investments. It is mostly about building a simple system and avoiding decisions that quietly sabotage it. The truly wealthy investor often looks boring from the outside. No flashy trading screenshots, no constant predictions, No emotional reactions every week. Just automated investing quietly running in the background for decades. So if you remember only one thing from this video, remember this. You do not need to predict the next NVIDIA. You do not need a finance degree. You do not need to watch the market every day. You just need a simple, low-cost system, automated investing, and enough discipline to stay out of your own way long enough for compounding to work. Most people spend their whole life trying to outsmart the market. The winners usually just outlast it, while everyone else is chasing shortcuts, reacting to headlines, and trying to predict the future. The patient investor quietly lets time do the work. Not because they are geniuses, not because they are lucky, but because they built a simple system and trusted it long enough for compounding to change their life. In the end, wealth is often less about intensity and more about consistency.